All right, guys, the time has come. I've really been looking forward to today, and the funny thing is, like, putting the slides together for today kind of gave me even more confidence in the indicator that we built here, because putting the slides together just kind of had the realization, we really nailed our goal. The first goal, of course, being creating a powerful tool, something we can all profit from. And to already get a lot of emails from you guys, you guys and gals emailing in saying, hey, got the indicator, took this trade, made some money. That's awesome. But the other goal was to make it really simple. And that was kind of my realization putting together the slides. It's like, wow, we've really nailed the objective on both goals. Really, really simple, but also really powerful. But all right, y'all, we will get diving in here. Typically with these classes, they give us about 4 hours. By no means am I in any rush to get out of here today. I'm going to give you guys all the time you need. But like I just mentioned, this indicator really is like super, super simple. And I think that's an awesome thing. So I'm not sure if we're going to need the full 4 hours. I've got a few slides I want to go through, kind of lay the foundation. But the quicker that I get through the things I want to discuss, and again, it's all pretty straightforward. Really all we're doing is following the pretty colors. The quicker we can get through all that, the quicker we can jump into running the scans, building our watch list, going through the big 3 checklists. And then, of course, it just leaves us some more time for, make sure all your questions get answered. So as far as the structure of today, we got about 4 parts. Right? So the good news is, guys, as far as all the criteria in part 1, those are all the ingredients that go into the indicator, all the ingredients that go into our signals. The truth is, you really don't need to understand any of them. As the teacher, I think it's important that you at least have a sense of, okay, we got a few different ingredients. Why are they in the indicator? So I do want to lay the foundation, show you why those things are powerful. But the theme you're going to see is that you actually don't have to understand it. If you can follow the pretty colors, you'll be in really good shape. So that's part 1, the ingredients, the checklists. Then in part 2, we'll talk about the indicator itself, our buy and our sell signals, the labels, the layout, all that good stuff. And then in part 3, that's where we're going to talk about the playbook. And for me, guys, it really is, at the end of the day, it's about 4 different trades. 2 bullish trades. And of course, we only do those on the setups with the big 3 buy signal. And then I've got 2 bearish trades. So not only is the signal super straightforward, so is the execution of the trades that have the signal. And then during part 4, that's where we're going to get busy. So I did put in the class folder earlier, let me pull it up here. This spreadsheet right here, and what I'll do for y'all is we'll pretty it up a little bit, but this will do for today. So in part 4, we're going to run the scans. We're going to build our watch list, and I'll take you through a little bit of my daily routine. And part of that is going to be looking at the indices, looking at the futures on the indices, and then looking at all the leading sectors and kind of filling these charts out here based on whether or not they're bullish, neutral, or bearish. An important piece of the puzzle. But for us guys, today's kind of just like day 1. So we did something similar with the last class. I think people really enjoyed it. And like I mentioned, the big 3 indicator is really not too complicated. So today is kind of like day 1 for us. Right? And obviously after the class, we'll have the live trading sessions. And real quick, keep in mind, if you're just here for today's class, at any point, if you want to upgrade for the live trading, reach out to customer support and they'll get you set up. I strongly suggest you at least consider it for 2 reasons. 1, if during our live trading, if there's any great setup out there, there's a pretty good chance we're going to find it. With the indicator, with the scans, with the labels, I'm just really confident of that. I think probably more importantly, if there's nothing A+ out there, nothing to do on the daily, the 2-hour, the 30-minute, no bullish trades, no bearish trades, we're going to keep our money. We're going to protect our stuff, so we're going to avoid trading the B+ kind of stuff. But what I want to do with all of you additionally is for the next 4 weeks, and we can start this Thursday, right when the market closes at 3 p.m. Central, 4 p.m. Eastern, privately, just the people here from the class, we'll do a live stream on the Focus Trades YouTube channel. That way we can continue to work with each other for about another month. Now, that's where we'll have more time together for Q&A. We'll do the scans. We'll update. We'll review trades. Really work a little bit closer together. So we did that after the last class. If that sounds good to y'all, let me know. But that is going to be the game plan. So what we'll do later is, we'll put the schedule. We'll get the schedule going for the YouTube channel, and then we can just email all of you the links each week. Make it nice and easy on you. All right, looks like you guys are down. If you're down, I'm down. But we'll kind of get going here. And usually, like with every webinar or class I do, I try to start with a question similar to this. So no different today. I'm curious, what motivates all of you to trade? Like deep down, outside of just like the money, the freedom, like what really motivates you to trade? And I'll give you guys a few minutes here. I'll kind of read through your answers. But, a big part of it to me, right, outside of the financials, outside of all that pretty stuff, big part of the motivation for me is just to make my heroes proud. My hero being, number one, my dad. So if you're asking yourself what's going on here with the sweatpants, I'm really not too sure either. Mind you, this was 1992. Styles have changed, thankfully. But that's my pops and I from back in the day. I'm sitting on his lap there. He's reading some financial publication. So my dad, he's ran his own wealth management firm since I was about 1 year old, as you can see. He was my introduction to the stock market. So one of those things where it's like if I wasn't born at the exact moment I was born, maybe would have never even have learned about the stock market. So at the top of the list of goals is to make him proud. But then I want to make my idols proud. Two of those guys, of course, being JC, Johnny F. Carter, and Henry Gamble. I really look up to those guys. Looking at a guy like Henry, a few years older than me, but he's just reached. There's that balance we're all chasing after, right? You're kicking ass and trading, you're making your money, but then you got the family, you got the new house. Like these are guys I look up to. And then of course JC, kind of at the mountaintop. And then that guy in the white shirt is my brother Chandler. He's a pretty damn good trader too. And then I also look up to guys like Kobe Bryant. A big reason I looked up to Kobe Bryant is, and I'm sure a lot of us here can relate. Some of us have that. Call it an obsessive mentality. So like my first obsession, the first real love of my life was the game of basketball. And what I mean by obsession is outside at 4 o'clock in the morning in the snow, getting up free throws, like hands cracking, hands bleeding, going to sleep with the basketball on the bed. So as a young dude, like I really kind of related to Kobe Bryant from the perspective of, here's a guy, multimillionaire, professional athlete, like top of the game, broke his wrist on his shooting hand. He's in the stadium after hours in his PJs putting up free throws with his left hand. He doesn't have to work anymore, right? At that point in his career, he's golden. But it's that obsession with the craft, right? The obsession to just continuously get better. So as a basketball fan, I kind of saw that in Kobe, and as life tends to be, what I've noticed is that that obsession can do you a lot of good. So I'm here today to say, guys, it's okay to be obsessed with your craft. And then, of course, the motivation to take care of my girls, take care of my little family. So that is Taylor too, my fiance. We're getting married in September. So you're going to have to deal with 2 Taylor Hortons. And then the cutie to the right is Cocoa Beans, the other love of my life, my co-pilot, my best friend. Not that good of a trading partner, but a good friend nonetheless. And then, guys, we got the trophies. Take care of your family. Do right by the people who did right by you. Reach your potential. And we've all got different interests and different, trophies that we want to accomplish in the long run. And of course, trading with the financial potential, trading can definitely be a route to reaching those goals. So for starters, I'm obsessed with cars. Specifically, I'm a huge Corvette guy. Like I love Lamborghini, like Ferrari, but Corvette, it was like the first car that I fell in love with. So the car at the bottom, the ZR1, I've actually got a picture of myself when I was like 13 at the Chevy dealership, and they let me sit in it. I thought it was the coolest thing. So the goal in the long run is to eventually get one and take an updated picture. Eventually, I'd like to sit courtside at the Celtics. I promised myself as a kid, one way or another, legally, maybe illegally, I'm going to end up on that Celtics court. At this point, the best option seems to be, let's just get some courtside seats. And then eventually, travel, the beach homes, pretty views. But for me, it all starts with, I want to make those guys proud. I want to do right by my family. And then I want a kick-ass Corvette. Balance, right? Balance, guys. Hey, Andrew, that's the goal, right? Why pick one? We can pick both. But the journey to the journey to where we are today, working for Simpler, being on the mic, creating the big three indicator, hanging out with you guys, all kind of started 8 years ago. So one of my mentors, another guy I want to make proud, a gentleman named Chris. Chris is like a brother to my dad. And really from a young age, he took me under his wing. So as a teenager, he let me sit in his office and just trade all day. So I was really blessed with some good mentors, but I think we all got a few days, in our lives that will kind of always look back as like a big turning point. I had one of those days like 8 years ago. Chris called me into the office and he said, "Hey, you ever heard of John Carter and the Squeeze?" I said no and no. He sent me back to my desk, gave me a link to a Squeeze video, and I was like, holy crap. Like this is it. This makes total sense. This guy seems legit. I can do this. Like I can take this, I can put this on my chart, gives me something to sink my teeth into. And then the rest is history. So the Squeeze, guys, and the Squeeze for me is one of two trades, but it's kind of like the foundation of everything. And to me, falling in love with the Squeeze was kind of the first step to quote unquote finding my identity as a trader. So what I'm really, really, really excited about, I hope to have kids in a few years. I really believe I can give my future kids, or I can give a brand new trader the big three indicator. And I think for years to come, the big three indicator can become the thing for a lot of different traders. But the whole journey kind of started with falling in love with the Squeeze, learning from John, learning from Henry, and then just really trying to perfect the use of that powerful indicator. But what I'm a big believer in, we're trying to put all our time and effort to being really, really great, like excellent, at one, maybe two things. That requires more work and focus, but I think it's a much better alternative than just trying to become a jack of all trades. One theme I've noticed growing up with a lot of successful traders, they've all kind of got that one thing. You watch JC trade, JC can do it all, but even JC's kind of got that one or two things, right? Guys like Henry, guys like Sam, they're able to do many things, but they do one or two things really, really well. And I'm a big believer in that. I think that's really, really important. But then the question is, okay, as far as, why build an indicator? Right? And, granted, the big three indicator is kind of built upon a lot of other indicators. So I have access to these things. Working it simpler, I got access to the whole treasure chest. Why do I need to go build an indicator? Like, why do we got to go through this whole process of trying to create something new? Biggest goal was I don't want to fall into the trap of trading anything but A+ setups. And even when I put all the other tools of the trade on my charts, it's easy to look at a chart and say, hey, that's good enough. A lot of times it isn't. So I wanted to find a way where, like, without thinking, like no opinion, and a way where I could just like call myself out if I'm breaking my rules. Wanted to find a way to trade nothing but A+ setups. Wanted to find a way to keep the emotions and the opinions out of the equation. The goal, guys, is we're getting to the point where you're kind of just operating like a robot. Like, sit down at the desk or stand up at your desk, run the scan, follow the pretty colors, like not too much emotion involved. But the biggest thing, and this was kind of like the aha moment, is we started to transition into a different market. Coming out of 2020, 2021, things have been a lot different this year. The biggest lesson for me and the biggest change, and probably at the end of the day, the biggest reason I'm really, really excited about My future as a trader moving forward, I don't want to rely on 1 or 2 time frames. And this is big for me, guys. If you've taken my previous classes, if you've spent time with me in the mastery or the gold room, or if you were in focus trades back in the day, I love me a weekly chart and a daily chart. We're going to have markets where, you know what? Yeah, if you don't want to, you don't have to focus on anything but those bigger time frames. We're not in the market right now where that's the case. So, for me, it was kind of this realization. It's not the time frame, it's the criteria. Right? All of the things that lead to my profitable trades on a weekly chart, a daily chart, those same exact things, that same criteria, it's left and right, even in this bearish market, on the lower time frames. So for me, that was a big lesson. Emphasize criteria instead of the time frame. So a trade we had a couple of weeks ago here in Zoom, that 30-minute squeeze that led to a nice pop, the only difference between that and the trades I like on the daily charts is the time frame. It's just going to work or not work a little bit quicker. But the trend, the structure, the momentum, everything that makes my favorite trade on a daily chart A+, comes together here for the same moment in time on a 30-minute chart. So looking back at 2020, 2021, in my career, guys, the easiest market I've ever seen. I think if a trader doesn't agree with that, I don't know what to tell you. It was just an easier market. So for all of 2020, March of 2020 more specifically, all I was doing was finding my go-to trades in weekly charts and daily charts. And when you get just like a bonkers, like cracked out bull market like that, it's a great way to go about making a living. Daily squeeze in Google, 15K. Amazon weekly chart. This is how nutty it was. I didn't even catch a move. I didn't catch a huge move here. I'm selling put credit spreads, and because the market's so damn strong, I'm just collecting premium. $13,000 profit. Nvidia daily chart, $6,000. Tesla daily chart, $5,000. We were in a market where you could take a small account. I think I started this one with about 32,000. 2, 3, 4 months later, you can be up 50, 60, 70%. Buy the dip on a daily chart, trade a daily squeeze, and because the market itself is just so crazy strong, it's just about all you needed. We're in a different market, guys. And I think a lot of traders in this market, just based on conversations I have with traders, there's like this just talk to a lot of traders that are kind of like discouraged because they, it's like this mindset that what was working back then isn't working at all right now. That's kind of the mindset. And I only agree with that. I agree with half of that. Yeah, trades off the weekly charts might not be working. Buying calls and holding them for 60 days might not be working. But that Nvidia trade I just showed you, that Tesla trade, the Amazon, the Google, all those big trades off the daily charts, the trade that we took last week in Cisco, aside from the time frame being lower, meaning things are going to move a little bit quicker, same exact moment in time. So if you guys got rid of the time frame, hit the time frame and just showed me the structure, just showed me the trend, showed me the buy signal, I'd say, yeah, that's my go-to setup. That's my favorite trade in the whole world. Get where I'm coming from? Like, there's a lot of this left in the market. So these are trades we took last week. Nice little base hit in Cisco. And yeah, trades on a daily chart, you can hold them for 2 weeks, maybe a month. You can make some big time returns. There's nothing wrong with finding a nice 30-minute squeeze, hitting it and quitting it, right? Taking a nice 15%, moving on to the next one. I'm looking for these moments in time anywhere, right? Even on a 5-minute chart, if we have that buy signal, we're jumping in. We're going to take that trade. So in the option Zoom last week, 5-minute squeeze in the QQQ, 5-minute buy signal. We bought some calls, and a few days later, we made an 80% return. The point I'm trying to make, though, hide the fact that's a 5-minute chart. That's the same exact setup that a lot of traders had a lot of success with as far as playing things to the upside in that 2020, 2021 market. Yeah, you can't find it too much right now on the daily chart. You're not going to find it anywhere on the weekly. It's all over the place if you can look a little bit lower. And that's the move that a little 5-minute squeeze that fit our criteria triggered over the course of 2 days. That's big time, right? 295 to about 305. That's a big time move. And the whole thing gets triggered by our moment in time, our signal, hidden all the way down there on the 5-minute chart. And then we had another trade last week in Coinbase. 30-minute chart, 30-minute buy signal. We want to emphasize the criteria and not so much emphasize the time frame. Adjustments have to be made, right? Time till expiration, strike selection. But hopefully this makes sense. Hopefully this is making sense. And then keep in mind, you only need a few per week. So as far as the trades that we opened and closed last week, and the great thing is I don't have to go looking for these. I'm not finding a Cisco trade because I'm pouring through charts for hours. I click one button on the scan, there's Cisco. I'm not running through charts for hours looking for coin or the QQQ. They all come up on the scans. We only need a couple per week. But then the other thing that I wanted from an indicator, I want to know when things are perfect because that's when I want to get active. That's when I want to get aggressive. But after I enter that trade, I need an easy way to be able to say to myself, hey, I shouldn't be here anymore. Let me know in the chat, guys, but kind of a rhetorical question. I think every trader has done this a few hundred times. But anyways, have you ever taken a trade and it's like, okay, I'm taking this trade because of A, B, C. And then A disappears, B disappears, and C disappears. Like every reason you took the trade is no longer present. Yet you continue to hold on. Then we start to sell ourselves like on these ideas as to why we should hold on. All right, well, none of the reasons I even took the trade are here. But because I'm a human being dealing with a brain, let me try to convince myself, okay, well, the market's at key support and, they got an upgrade this morning. We're holding support. If I'm being honest with all of you, that's where I got into my biggest trouble as a trader, like repeatedly. I've never really had a big problem with taking crappy trades. Like even since early on, one of the things I've done well is just narrow down the focus to some good criteria. The piece that's been missing for me to get to that next level, because there's, as they say, there's levels to the game. This biggest step for me, what was missing was the ability to get in a trade when it's picture perfect, and then with like zero emotion, be able to look at the chart and say, hey, I got to get out of here. That's one of the more powerful things the big three indicator has done for me. Now I'm only taking a trade when it's freaking perfect. But then I've got a visual aid here, right? The disappearance of my buy signal that literally is communicating to me, hey, this stock on this time frame, it's not for you anymore. It's not A+. Basically, the indicator calls me out. It's like, all right, Taylor, you talk a big game. You say you only want to trade A+ stuff. What are you doing sitting here in Pepsi? Neutral from head to toe. So I think for a lot of traders, it's not even that knowing what to trade and when to trade it is difficult. It's just the emotions that really start to play a negative role when it's time to cut things loose. And that also applies, guys, to when do we want to take profits? But I do think the signals here make that a lot easier. So of all the trade decisions that I'm quote unquote proud of last week, it's not the trade in coin. It's not the trade in QQQ. It's not the trade in Cisco. My best move last week was getting my team out of Pepsi because Pepsi was no longer A+ on any time frame. That to me is way more important because the Ciscos, the coins, they take care of themselves. When they behave, they behave. So now we'll jump in here, guys, right? We'll go through part one. Like I mentioned, you really don't need to fully understand DMI, ADX, stack DMAs. I want you to have at least a basic understanding. And granted, I know a lot of you here, y'all know this stuff. But briefly, we'll fly through part one, We'll talk about the different ingredients. Why is the squeeze important? The Keltner channels, the EMAs, all the other good stuff. Then we'll do is, guys, I'll take a quick 5-minute break. Then we'll come back. We'll do some Q&A. So if you have any questions on the things we discussed already, we'll bang out the questions, and then we'll move on here to part 2. So as far as everything that goes into our buy or sell signal, right? Everything that goes into the big 3, as far as the ingredients, the indicators, it's the squeeze, the love of my life, the moving averages, the stacked EMAs, ADX and DMI, and then the Keltner channels. That's it. On their own, yeah, moving averages are helpful. Stacked DMAs are really helpful. ADX and DMI, aka the 10x bars, really helpful. It's the combination that makes it really, really powerful. So, for starters, y'all, the squeeze. Let me know in the chat, how many of you are using the Squeeze Pro versus the original squeeze? Show of hands here. Yeah, most people using the Pro nowadays. All right, so here's the good news, because I use the Pro as well. If you're using the Squeeze Pro, these signals work great on every level of compression. Your low compression squeeze, your mid compression, your high compression. For what it's worth, for any of you here who don't use the Squeeze Pro, my favorite squeeze is the original, the red dot squeeze, the mid compression. And because that's my favorite, as you'll see, we've built a little something into the indicator that'll show you, hey, here's your buy signal plus a mid compression squeeze. But keep that in mind. You can use this on the original or on the Pro version. In terms of the indicator and how we wrote it, the indicator was only looking for the original squeeze. And who knows, guys, maybe the Big 3 Pro will come out in the future. But as far as the squeeze goes, this story always makes me laugh because it was just terrible risk management. But this was about 7 or so years ago. Like, this is after I really started to love the squeeze. Like, the squeeze is my thing. Sitting in Chris's office, the financial sector had a bunch of squeezes. Bank of America, Goldman Sachs, Wells Fargo, Morgan Stanley, like the whole shebang, whole financial sector squeezing. So being 20 years old, not too many bills, not too many responsibilities, thought it'd be a good idea to just basically put my entire account into each of those squeezes. So for diversification's sake, bought calls in Wells Fargo, calls in Bank of America, calls on XLF, calls on Morgan Stanley, calls in Goldman. Don't do that. Hopefully we all know that. Don't do that. One, don't ever put your whole account into, don't ever put your whole account into basically the same trade. Pretty low odds that if Bank of America rolled over, that Goldman Sachs was going to rally. Right? It's basically the same trade. But nonetheless, guys, fortune was in my favor, thankfully. Woke up the next morning, squeezes all started firing long. Held it overnight. Probably the most nerve-wracking night of my life up to that point. Got another gap up the next day, and $18,000 later, that's when I knew the squeeze and me were going to get along. And the squeeze continues to play a big role in the journey here. So the way that I got noticed by Simpler, I would show up to the office and just scratch on the door like a stray cat. And then one day Amelia opened the door and was like, all right, let this guy in. Enough is enough. No, what I really did was, I had a chat room going, had a YouTube channel going, which, of course, we still got the Focus Trades YouTube. I made a video about the squeeze. How to trade the TTM squeeze setup, the best setup for options traders. Based on my YouTube channel size, the video kind of took off, and a few people from Simpler actually found the video. So they reached out to us. Long story short, that's how Chandler and I became a part of the team. So kind of a cool journey, right? Get called into my mentor's office. Hey, you ever heard of the squeeze? Fall in love with the squeeze. Right? Got my first taste of, quote unquote, big money from trading the squeezes. Go on to make a video about the squeeze. Then I get noticed by the simpler team, right? The team I've been watching for 5-6 years. Now I get to hang out with you guys and make some squeeze videos. So very, very cool journey indeed. But what you'll notice is with a lot of traders here at Simpler, for a lot of us, the squeeze is kind of like the bread and butter. It's the foundation, like a really, really big piece of our puzzle. And the power is, guys, the squeeze helps us find, and you can probably hear John's voice, the moment in time when the stock is getting ready for a bigger than expected move. Right? Now, bigger than expected move is an options trading term. I'm a plain English kind of guy. The squeeze helps us identify that moment in time when the stock is gearing up for a meaningful move, right? A big move, a ripper, a flush, something with some meat on the bones. Whether we're trading 5-minute charts or weekly, I think we're all in agreement. We're trying to catch big moves. But you got to keep in mind, what makes the squeeze powerful is just kind of the nature of the market itself. I actually kind of think 90, but 80% of the time, the market's not doing too much. There's really not too much for us to work with as far as like really strong direction either which way. The beauty of the squeeze is the squeeze helps us find when that stock is gearing up to do what stocks do the other 20% of the time. Right? That's when they're making those powerful, concentrated directional moves. But the key with the squeeze is, right, and here's how you make the squeeze profitable. We're planting our seed, we're getting long or short way before that powerful move. Then we get to take the profits into the strength. And of course, we're doing this across any time frame. So what you'll notice is, as far as the the trend of the market, a lot of times the trend is triggered by squeezes. So yeah, we had COVID, you had the Fed pumping in money, J Powell, the money printer. I get all of that, but from a perspective we all understand, a language we all speak, the beautiful language of the squeeze, that crazy ass market that we traded in 2020, 2021, from a squeeze perspective, all that was just a result of a big whopping monthly squeeze firing to the upside. Like I get the context of what was going on, but the squeeze also worked as advertised. Squeeze fires, being that it's a monthly chart, that triggered our entire bull market rally. What happened to our bull market when that monthly squeeze starts to get a little bit tired? Histogram goes from light blue to dark blue. Our bull trend ended. Same thing on weekly charts. So a lot of the best buy the dip opportunities last year was buying the dips into weekly squeezes before they fired to the upside. But you also see, of course, weekly squeeze works just the same in a downtrend. Big weekly squeeze, big dump to the downside. And of course, with the current market, and we're going to look at charts later, of course, we'll build our watch list. We have a daily squeeze right now in the S&Ps. So out of curiosity, guys, there's no right or wrong answer. Because the big 3 bars are neutral on the S&Ps right now. But out of curiosity, do we think this squeeze fires long or short? Again, no right or wrong answer. I'm just curious. I'm just gauging what you guys think. Short, 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 long, long, short, long, short. Well, the good news is, okay, long, short. The good news is, half of us will make money. Seems like half think long, half think short. We'll come back to this chart later. We'll definitely come back to that later. But then you got the squeezes, guys, on these lower time frames. Right, so that's the theme I really want to pound today. We'll play ball wherever we can play ball. And we're only going to play ball, right? We're only going to trade on the time frames that have our buy signal. If it happens to be the 4-hour, that's what we're operating with. But I used to have this mindset, and I'm just realizing so much lately, it's not an appropriate mindset. Yeah, forget the 15-minute. Yeah, forget the 5-minute. I used to ignore all those lower time frames. Right? But again, criteria versus time frame. And as far as the bullish opportunity goes, we're just not in a market where that bullish opportunity is going to be all over those bigger time frames. So we'll take them wherever we can get them. And here's been my experience for the last 7 or 8 years. And again, to be transparent, up until recently, really up until this year, almost all my trading was just trading squeezes off the weekly and the daily charts. As I learned different rules for myself, right, different criteria, all the things that go into the big 3 indicator, what I found was, yeah, it's relatively, I don't want to use the term easy, but it's definitely achievable to have about a 70% win rate trade in those weekly daily squeezes that fit that criteria. Now with our indicator, I think that's achievable now more than ever, but I think our opportunity set just opened up so much. I'm really confident we can achieve that same win rate, whether we're doing it on a daily, a 4-hour, a 2-hour, a 1-hour, down to a 5-minute, because we're only going to trade these squeezes when they're A+, right? Everything lining up. So this is one of the golden rules of the squeeze. Doesn't necessarily apply to how we're looking to trade, but one of the golden rules, typically when a squeeze fires, the directional move, the release of energy, tends to last for about 8 to 10 bars. So a weekly squeeze can last for about 8 to 10 weeks. That monthly squeeze that fired, I think that lasted for about 12 months or so. So that kind of works as advertised. A daily squeeze can last for 8 to 10 days. An hourly squeeze can last for 8 to 10 hours. For us, though, guys, what we're looking to do is trade the squeeze and just simply catch a push into our target. If it happens in day 1, we're not going to hang on for the next 7 days. We're just looking for a push into our target. Then we're on to the next trade. But that's my motto, right? Find your thing, find your niche, live it and breathe it. So I do like to buy the dip. I do like to short the rallies, but it's probably closer to 95%. 90% of my trades I take are squeezes. Of course, the key to success, though, we need an easy way to dictate whether the odds favor that squeeze firing long or short. All that means for us here today is just simply following the pretty colors. We don't have to go looking at 5 or 6 different indicators. We're just following those pretty colors. So there's a squeeze. Right? Then my favorite moving average, and this ties in the whole strategy, is that 21 EMA. Right? The 21 period exponential moving average. And we hooked you all up with the other chart links. So if you're on Thinkorswim, you should be good to go. But just in case you need it, there's the chart settings. Pretty straightforward. Find yourself an EMA, length of 21, and always personal preference how you want to spruce it up as far as the colors go. But the EMA is home base. Right, so if you ever hear me on the mic and I say, yeah, Google's going to come on back home eventually, what that means is Google eventually is going to pull back to the 21 EMA. Or if something's in a downtrend, eventually it's going to come on home to that 21 EMA. It's a general statement. That's what a market does. We push away from that 21, we pull back to it. So for bearish trends, like zoom to the right, you get the flush. We want to short those at the 21 EMA. Right? That's the ebbs and flows of a downtrend. And then to the left, you can see the ebbs and flows of a uptrend. We consolidate at the 21 EMA. We rip off it. We pull back to it. Right? We always come home. We rip off it, come back home, come back home. But you also want to look at that as a launching pad. Right? If I go back to those slides, notice how the powerful part of that move, the move that we're looking to catch, really starts at that 21 EMA. Whether we're in an uptrend, that's where you get the most oomph, right? Lift off the launching pad. And the same thing in a downtrend. The biggest flushes, the most explosive moves to the downside tend to take place at the 21 EMA. So for that reason, that's the launching pad. And that plays a big role in terms of, hey, where are we looking to take entries for our longs and for our shorts? So looking at Zoom, we know the squeezes are a buildup of energy. It's only one piece of the puzzle, though. One piece of the puzzle. But if I'm going to trade a squeeze and I'm going to buy some calls, always taking that entry at the 21 EMA. We're building up energy. We're doing it on the launching pad. Those are all signs of a stock ready to take a lift off. So we always take our entries, guys, at that 21 EMA. But that just ties in that concept. In other words, the ebbs and flows of the market, reversion to the mean. So just remember that. It's a really big rule. All stocks do, whether we're looking at a 5-minute chart, whether we're looking at a weekly chart, uptrend, downtrend, every stock, every market heads back home at some point. So if you look at the glory days from last year, bullish trend in the QQQ, we pull back to the weekly 21, we rally off it over and over and over again. Big push, reversion to the mean. Big push, reversion to the mean. Big push, bull market dies. All right, now we're in a bear market. Big flush. We don't want to get short down there because there's a pretty good probability we're going to revert to the mean. We get a big flush. And at the moment, guys, I do think there's the potential. The Qs and the S&Ps might be gearing up for a little bit more upside to finally go back home. It's been a while since we went home here on the weekly chart. That doesn't mean the downtrend's over, but all stocks, all markets, and every time frame revert back to the mean. So Cisco, and this is on our watch list for next week, as far as like an active opportunity. But you'll notice last week, get the squeeze, get the buy signal. Very nice push on a 30-minute chart, comes back home. Still bullish, still have that buy signal. Nice push, comes back home. Nice push, comes back home. Now we're going into a new squeeze. So once again, we're going to look for that push off the launching pad. But there's a reversion to the mean on a 30-minute chart. And the S&Ps gap up last week. They gap up again. In the short term, it's not sustainable. We got to shake out a few hands, a few weak hands. Pull back to the hourly 21. Big rip, get a little bit too cooked, dip to the 21. Big rip, dip to the 21. So there's reversion to the mean on the hourly chart. And this concept's going to save you a lot of money if you can respect it in a bear market because, big, call it a feature, I guess, of this current market. This market loves to set traps. This market loves to push traders to the point of, panic. Oh my God, the market's going to collapse. Everything's going down. I got to buy puts, buy puts, buy puts. The market loves to do that, make you feel that way, and then just absolutely rip against you. So guess what? We want to be careful getting short when we're a long way from home on any time frame. Did that rally change anything about the structure? No. But man, you're buying puts down there. That's going to sting. Right? Reversion to the mean. So as far as 21 EMA, we got two rules. On any time frame, our goal is to take our entries, long or short, at the 21 EMA. And we want to take our profits before that reversion to the mean. Rule number 2, I think a really important one, and I'll show you why later. Even if I'm taking my trade based on the 30-minute signal, 15-minute signal, 4-hour signal, I want to aim to take my trades as close to the daily 21 EMA as possible. Even if I only have a 15-minute buy signal, my preference is that 15-minute buy signal is as close to that daily launching pad as possible. Right? Keep that in mind for later, but we're going to come back to that. So coin is a good example. Right? That moment in time on the 5-minute chart, the 15, the 30-minute, the yellow line there is a daily 21 EMA. Right? Call it the ultimate launching pad. We're not in an uptrend. I don't have daily buy signals, but I found my moment in time on top of the daily 21. We're not in a market, guys, where we need the daily charts to have picture perfect trend, buy signals up the wazoo. What we need is for our lower time frames to come together enough to give us that moment in time. But if we can catch that moment in time close to that daily launching pad, that's how a little 15-minute squeeze can lead to a pretty significant push. That's where in a couple of days you can take home your 80, 90%. So we got our squeeze, right? We got our 21 EMA. And we got a couple more things to cover here, y'all. Then we'll do a quick 5-minute break. And then we'll come back, do some Q&A, and we'll keep the party going here. Again, you don't have to understand this, but it's really important. So one of my bigger mistakes in my my journey of trying to perfect the use of the squeeze and just perfect directional strategies, I used to hear John talk about the stacked DMAs all the time. I ignored it. I thought it was goofy. I thought it was a little bit too much. I was like, all right, man, enough with you and your stacked DMAs. I just want to trade the squeeze. Being 20 years old, I knew it all, right? Learn that lesson the hard way. Stacked EMAs is one of the most important pieces of the puzzle, but you don't have to understand why. The big three indicator is going to do that for you. But as a preface, guys, this is our structure tool, right? So everything that goes into our indicator is based on trend, structure, and momentum. The stacked EMAs, that's where we get our structure from. So for any bullish trade we take, 5-minute all the way up to a daily chart, we need positively stacked EMAs. Technically, this means the 5 EMAs above the 8, the 8 above the 21, 21 above the 34, 34 above the 55, 55 above the 89. Plain English version, that is bullish structure. So for that Zoom squeeze, I got a sense already there's a better chance of this firing to the upside because it's a squeeze with bullish structure. We have the labels, of course, right? And I'm sure a lot of you have the stacked DMAs label. The label's beautiful. We get rid of all the moving averages. We put the pretty label up there. It does that work for us. For what it's worth, I threw my stacked DMAs label away. I don't need it anymore. I just need the big three. Because if I have a chart with stacked DMAs, but everything else is crap, I'm not taking it. And that's how I used to get into trouble. Taking the B plus setups. All right, well, this isn't picture perfect, but it's 80% of the way there. And I'm on the mic, and these folks are looking for trade ideas. Yeah, we'll take it anyway. Can't be doing that. I can't do that. Y'all can't do that. We need the stacked DMAs, but it's just a piece of the puzzle. So for what it's worth, I don't even have the label anymore. So for bullish setups to be A+, regardless of time frame, the EMAs have to be stacked positively. No questions asked. No positively stacked EMAs, you're not going to see us getting long on that time frame. And then for bearish trades, guys, it's the opposite. Negatively stacked DMAs. So the 89 is above the 55, above the 34, etc. So by design, we're only getting buy signals when the EMAs are stacked positively. You don't have to go look at all this stuff anymore. The pretty little arrow is going to do it for you. And we're only getting sell signals when those EMAs are stacked negatively. So as far as our ingredients, this is our structure ingredient. But the theme of the good news today, Big Three is doing all of that for us. And I think that is a beautiful thing. So when I shorted that squeeze there in McDonald's in our mastery, we're under the 21. So we're underneath the launching pad. Guess what? If the rocket ship's not on top of the launching pad, it's probably not going to take liftoff in that direction. But then the structure with negatively stacked EMAs tells me, okay, structure is bearish. There's a much better probability of this squeeze firing to the downside. And then the last piece of the puzzle, guys, for our trend, structure, momentum is our trend and our momentum tool. You don't have to understand it. Big Three does that for you. But momentum and trend, we're getting that from ADX and DMI. If ADX, the white line up here, is above 20, you got a bullish trend. If ADX is below 20, you've got a bearish trend. Then we got DMI. Green above red, momentum is bullish. Red above green, momentum is bearish. So see how it all kind of ties together now? All right, I found my squeeze, so I know Zoom's probably getting ready for a nice directional move here. My EMAs are stacked positively, so now I know inside of the squeeze the structure is bullish. My ADX is above 20. I know my trend is bullish, and my DMI is green above red. So now we just found a 30-minute squeeze with bullish trend, structure, momentum. Does that trade work every single time? Of course not. There's not a trade out there that does. But that's what has to come together to pump out that 70% win rate. The power of the big three is if one of these things is missing, we're just not going to get a buy signal. And we can't concern ourselves with, well, how come we don't have a buy signal? Is it the stacked DMAs? Is it the ADX? Is it DMI? Who cares? We don't care. We're just trying to trade the pretty stuff. So if we're buying a dip on a daily chart, if we're trading a daily squeeze, we need a few things to come together. Positively stacked DMAs, ADX above 20, DMI green above red. Well, now we're at the point that all we need is a pretty green arrow. Green arrow's checking everything for us, says, hey guys, this checks out. And I'll let you know as soon as it no longer checks out. Awesome, awesome stuff. And for bearish momentum, of course, the opposite. That bad boy ADX is below the white line. We got a weak trend. So by default, for us, we're never going to get long inside of a weak chart because we're not going to get our buy signal if ADX is below 20. It's not possible. DMI red above green, bearish momentum. So McDonald's is in a squeeze. I know this is getting ready to do something, right? Stocks just trade sideways 80% of the time, but in a squeeze, we're gearing up for the magic that happens the other 20% of the time. How do I know if I should get long or short? EMAs were stacked negatively, bearish structure, ADX below 20, bearish trend, DMI red above green. Trend, structure, momentum points towards you get a better chance of that squeeze firing to the downside. So ADX and DMI, those are the trend and momentum ingredients. You don't have to understand them. They're really powerful. They're the foundation of a lot of our other powerful indicators, but the big three will find all that for you. So we're only going to get our buy signals when ADX and DMI fit our bullish criteria. If they don't, no buy signal. And we only get our sell signals when ADX and DMI fits the bearish criteria. Of course, the good news. You all know the good news. And then last piece of the puzzle here, guys, the Kelts, the Keltner channels. So remember our goal. We got a couple different goals. Trade nothing but A+ setups. Don't think. Part of not thinking is, okay, well, I'm up 80%. Man, if I can just catch a little bit more of a move, I'll be up 100%. And we've all done this as traders. Let me know in the chat. I want to see how many of you have done this. It's the most ridiculous thing. Okay, I'm up $900 on this trade. You know what? If I can just catch a little bit more, if I can go up $1,000, that's just somehow so much better. Like we convince ourselves of the silly crap. One of my most painful F-ups ever, kind of the only good way to put it. This is when my fiance and I had just moved into, my girlfriend at the time. We just moved out of our parents' house for the first time. So hello, real world. Hello, responsibility. Yeah. Now I got a bunch of bills. It's funny. The world kind of clocks you on the chin once you jump in. So anyways, now I got these responsibilities. I got these bills. I'm an adult all of a sudden. Long story short, got a couple of trades on. Trades are working. I was up about, let's call it $9,200. Right, I'm up $9,000 and change. That afternoon, my buddy needed me to help him move into an apartment. Guys, don't be afraid to say no to your friends. I would have avoided this whole problem if I just said no to my friend. But anyways, I got to head out in 30 minutes. I'm up $9,200, and I'm sitting there doing the math. Wow, man, I'm up $9,200. My rent is about $1,500. Wow, we just moved in, and in one trade, I've covered 6 months of rent. Then I started making mistakes. Well, it's a lot better than $9,200? $10,000. So before I hit the road, let me just leave these trades open, and I'll keep an eye on it while I'm driving, which is also a terrible thing to do. Too many of us do that. I'll keep an eye on these while I'm helping out my buddy, and I'll take the profits and I'm up $10,000. Can any of you guess what happened? See if anybody can guess what happened. Yeah. 9,200 turns into 8,000 to profit, to 5,000 to profit, to 2,000 to profit. I went home down $400. Convince myself, because we do this as traders, because we're human beings, that $10,000 was going to be a total game changer versus the $9,200. The 6 months of rent that I could have put aside and just chilled for my fiance and I. That little mental mistake, right? Think about what that cost me. It cost me $9,600. Not really, right? I only lost 400, but y'all get where I'm coming from. So the reason to me the Keltner channels are so important is now I can catch myself falling into a little bit of that stupidity. It's like, all right, man, you're pushing it here. Like, you've got some guidelines, you're pushing it here. So whether we're looking at the big three, whether we're looking at different indicators, a good indicator is going to help you find profitable trades. A good indicator is also going to help you call yourself out on your own crap, if that makes sense. So there's my horror story, guys. The moral of it is, don't help your friends move into their apartment. It would have been much more cost affordable had I just hired him a mover for the day. So lessons learned. But anyways, as far as the Keltner channels here, on my charts, we plot two sets of Keltner channels, right? The gray and the red. And what these measure are average true range moves above and below our 21 EMA, our launching pad. So the average true range, that's the average move the stock has been making over the last 14-day period. Normal price action, right? Chop, just squeeze action, noise, takes place between +1 and -1. That's typically where we're looking to take our entries, right? During that buildup of energy. Our profit target for longs and shorts is the push through +2 or -2 ATR. Now, I think in a stronger market, we can look for about 3 average true range moves to the upside. I really feel strongly we're in a market where we want to get our piece and get the hell out. So for now, I'm looking for pushes through +2 on my bullish trades and below -2 on the bearish trades. And again, we got the chart links for y'all, but these are the Keltner channel settings for the +1, -1. And I'm showing you this because it's simple, but factor of 1, length of 21. Just make sure, for those of you using Thinkorswim, make sure you change your average type to simple, to exponential. By default, it's simple, and even I sometimes make the mistake of not checking that, and then things are a little bit goofy. Right? Factor of 1, length of 21. So we're measuring one average true range move above and below the 21 period exponential moving average. And then you'll throw on another set there for +2, -2. But where this becomes powerful, right, going back a few slides, this is where we tie in that concept of reversion to the mean. Where there's a really strong probability of that reversion to the mean around the corner is when we're hanging out at +2, at +2 or -2. That's the ebbs and the flows. So if McDonald's fits all of our bearish criteria, there's a squeeze. We're at the launching pad. There's negatively stacked DMAs, ADX, DMI, etc. We want to catch that flush to -2. We want to get the heck out of there before that reversion to the mean. So for bullish trades and bearish trades, guys, that is almost always going to be the target. If I'm trading a 15-minute chart, I'm almost always going to look for a pop to about +2 or maybe 3 on that 15-minute. Same thing to the downside. But that's how you avoid becoming the short squeeze. I've been there before. I'm sure we've all been there before. Wow, McDonald's is falling apart. This thing's going to get creamed. While it's a few miles away from that 21 EMA, let me come in here and buy some puts. That sucks, because then you are the short squeeze. You're part of that face-ripping rally. We really want to avoid that. And same thing if we're trying to play it to the upside. What we're trying to do, guys, is just consistently get the easy part of the move. So could McDonald's go to -3, -4, -50? Yes, of course it could. But we want to think in terms of, hey, what's going to serve us well over the course of our next 100 trades? It's following these rules. Take profits at that extension. All right, so for bullish trades, taking profits into the strength, feeding the ducks, as John says. He should start saying feeding the kangaroos and the zebras at +2. And for bearish trades, we feed the ducks on the weakness at -2. So those are the ingredients, guys, of our checklist, right? On their own, they're all powerful. Combined together, all at one time, incredibly powerful. So like I continue to say, you don't need to understand those things. You don't need to concern yourself with ADX or DMI. You don't have to concern yourself with positively or negatively stacked DMAs. The indicator does all of that for us. But at a basic level, to at least have a good grasp of why are the ingredients in here. Little overview there, guys. So for our bullish checklist, I'm looking for squeezes, looking for something at the 21 EMA. Got to have those positively stacked DMAs. We have got to have bullish ADX and DMI, and then we stick to the script. All that comes together. We get long at the 21. We're taking profits at +2, maybe +3. Bearish checklist. I like to look for a squeeze, trading at the 21 EMA, negatively stacked DMAs, bearish trend and momentum. All that comes together, short it at the mean, take profits on the flush to -2. All right, y'all. That is part one. So I'm seeing a lot of good questions here. Let's do this. We'll take a quick 5-minute coffee break. Coffee break, water break, take your pick. And then we'll come back. We'll spend a few minutes answering some questions, and then we'll keep it moving. But remember, the quicker we can get through all the slides, then we can get into the scans, the watch list building, and then I'm willing to hang out as long as y'all need to make sure we get every question answered. So quick 5-minute break, and we will get back to it. So I'll pull up these pretty charts here. Let me leave you guys with something pretty. I happen to think Cisco on a 30-minute chart is pretty. And I'll get a note up here. Coffee break. Back at 1:11 p.m. Central. My math correct here on the time conversion? Yeah, perfect. All right, y'all. See you in a few. All right, guys. It is hot in Massachusetts today. It is hot indeed. All right, let me jump in the chat here. I'll get the slides back up. But yeah, if you guys got any questions on the things we discussed there in part one, throw those at me now. We'll kind of bang out a few. Then we'll keep it moving. Slideshow. There we go. All right, let me get caught up here. Horse stock, the difference between the 5-minute charts on the left and the right. Horse stock, are you referring to this chart over here? If you are, that's just a random chart that I'll throw a ticker on during the day if I want to keep an eye on it. So as far as a layout here, guys, in order of importance, this chart's the most important. That's got our multi-big 3 labels. So boom, Cisco, 30-minute buy signal. Then, of course, we got the main screen right here. Right? Our big chart, Keltner channels, our moving average, the squeeze. Everything else you kind of do as you please. Over here I got the ticks. Always keep an eye on the ticks. We had a position in Cisco, so keep an eye on Cisco. And then what we have over here, and we'll talk about all this later, but these are the multi-squeeze tabs. for the Squeeze Pro. So, for example, if we were to pull up Boeing here, okay, 2 hour, 1 hour buy signal. And now I know there's a 1 hour squeeze. So I put the multi-squeeze tabs there. You can put whatever you like, quite frankly. You could always get rid of it as well. But the 5-minute chart over there, just a random one. Just a random one. Tim, how to save the setup? Yeah, so Tim, what you would want to do, and yeah, if you guys got any questions as far as like the chart settings or workspaces, we can do all of that. But what I'm doing here is the flexible grid. So with the flexible grid, that's where we can start adding different charts and kind of, building our layout. But as far as saving that, you would go to, where's the tab here? You would click that icon right there and then save flexible grid as. Of course, I call it Big 3. So that'll save your layout. And then as far as saving the workspace, making sure it all stays the same, you just want to save the study set. But we'll definitely go through all that later, guys. Make sure y'all are up and running as you should be. Horse stock, that's a good question in terms of, hey, when do we get out of a trade? That's coming up in a few more slides. Awesome questions. Awesome questions. All right, guys. ADX is strength of the trend. Highly bullish or bearish? Yes, Chickadee. Yep. Yeah, and Bob, in terms of, I think as a general statement, stick to the rule of, if we're looking for a bullish trade, let's just get long above the 21 EMA. So for example, Boeing gaps up, pulls back. Yeah, we could have gotten long right there. We still have our buy signal. I just preferred a little bit of extra confirmation of getting back above that 21 EMA. So technically the entry zone could be anywhere between +1, -1. My preference, if we're going to get long, let's get long on top of the launching pad. Because that can work down here, but it could also start to fail. Then we lose our buy signal. And I think just waiting for something to hold above that 21 EMA, that gives us a better chance of getting the move to fire in our direction. But all right, guys, we'll keep it going here because I'm seeing a lot of good questions, but they're all a lot of questions we're going to talk about in the next few slides here. So we'll hang around all day to make sure we get all the questions answered. But all right, part 2, intro to the beast, the Big 3 indicator. So just remember, right, every trade we take, want everything lining up for us. So the Coinbase trade, stack DMAs, ADX, DMI, QQQ, ADX, DMI, stack DMAs. I feel like this is a lot easier. It's a lot prettier to look at, and it's a lot more straightforward. We got our green arrow. We know it's all coming together. Got the green arrow. We can get to work. We can do that on a 30. We can do it on a 15. We can trade the squeezes. We can buy the dips. So what we did was, and as you guys know, took all those ingredients, took all the criteria, in a nutshell, just took my entire checklist for these kinds of trades, threw it all together into one indicator, the Big 3. So what our indicator does is plots our buy and sell signals on the charts with the green or the red arrows, right? And the motto is no signal, no trade. But then we also have the multi-time frame labels. That gives us a bird's eye view of all of our signals across multiple time frames. And keep in mind, the label will coincide with the arrow on the chart. So if none of the labels are lighting up with a buy or a sell signal, you won't have any arrows on the chart. If your 5-minute chart has a green arrow, your 5-minute label will be green as well. But of course, we're only getting these signals when it all lines up. All right, so there's the layout. And like I said, to me, that's the star of the show. That's the star of the show. I can look at the cues and it's like, okay, boom. 1 hour, 30-minute, 15-minute, 5-minute green label. Because those time frames fit my criteria, now I can go to any of those time frames and look to work my bullish trades as long as the signal stays printed. Right. And the labels, guys, right, straightforward. So green label on any time frame, that's our buy signal, right? Bullish criteria is met. Of course, the red label, it's the bearish criteria, right? That's the sell signal. And then if a label is yellow, that's neutral. It's not bullish, it's not bearish, it's just kind of chop. As far as a directional trade, we never want to take a position when things are just neutral. Now, it's okay if all your bigger time frames are neutral and you got a signal on the 15 and the 5 minute. Just understand the context. You're only looking for that bearish opportunity off of those lower time frames. So a trade off of a 15 minute or a 5 minute probably not going to last as long as a short that you would take with a daily or a 4-hour sell signal. Vice versa for the buy signals. So this just puts everything that we need together at once. Makes our job really easy, right? No thinking, no opinion, no biases towards, this is my favorite stock. I know the stock's going to rally. We either have the pretty colors or we don't. We either got them or we don't. But then we have even prettier colors, guys. So if a label or an arrow, and again, they go hand in hand, if one of our signals is bright green or bright red, that means our criteria lines up and there's a mid-compression squeeze, right, which we talked about a little bit earlier. That's my favorite squeeze. Right? So now the label makes it easy for me to find my go-to setup. Bullish or bearish criteria with that red dot squeeze, that mid-compression. So like I mentioned earlier, with the Squeeze Pro, you're looking for different levels of compression. Right? You got the low compression squeeze with the black dot. You got the red compression, the red dot squeeze with mid compression, and then you got the high compression squeeze with the orange dot. The original squeeze signal is the red dot. That's my favorite. So anytime we see a bright green, bright red, just know that we have our criteria and we have that red dot squeeze, the OG original squeeze. So whenever I see something like Cisco, it's kind of a no-brainer. As long as the options are good, pretty good chance I could take a trade here. I can go look to work one of the trades from my bullish playbook. And there's only 2 of them, which you'll learn more about here soon. So that's the difference between the dark green, dark red, and the bright green, bright red. The bright signal means you have your signal plus a mid-compression squeeze. All right? So for our buy signals, the bullish bean, as I call it, whenever we have the green arrow or the label, the time frame and the time frame above it meet our criteria. And then we'll talk about that in a second in terms of what do I mean by the time frame above it. But as long as we have our buy signal, what that really means to us in plain English is the path of least resistance is to the upside. So on setups with our buy signal, all we're looking to do, we'll take it on a 5 minute, we'll do it on a 4 hour, a 30 minute, a 15, a 5. We're looking to execute the bullish playbook trades. But here's what we're really looking for. So with the indicator, there's built-in multi-time frame analysis. What we're really trying to find is trend, structure, momentum inside of trend, structure, momentum. So in order to get a buy signal on any time frame, the time frame above it has got to fit some of our criteria as well. In other words, if your 2-hour chart looks good, but the 4-hour chart is a disaster, I don't want a 2-hour buy signal. We only want to buy a daily chart inside of a bullish weekly trend. Does that make sense, guys? All right, so for our buy signals here, daily buy signal means the weekly and the daily lining up together. A 4-hour buy signal is based on the daily and the 4-hour. A 2-hour buy signal is based on the 4-hour and the 2. 1-hour signal based on the 2-hour and the 1 hour. 30-minute based on the 1 hour, 30-minute, etc., etc. So why do you guys think right now we aren't seeing many daily buy signals? Or quite frankly, why aren't we really seeing any daily buy signals? Can any of you guess why? And we'll pull up the charts here. I'm going to show you why, but I'm curious to see if anyone can guess. Yep. These weekly charts stink. These weekly charts stink. All right, we'll go take a look. I'll show you a few here. First, I'll show you the last few names that consistently had the daily buy signal. Energy, natural gas. Quite frankly, that's been about it this year. Daily buy signal, right? Just week after week after week after week. I don't want to trade this if we're in a weekly downtrend. So yeah, the daily chart's got to come together for me, but I only want that inside of a solid weekly chart. That makes sense, guys? Right now, the chart of Valero on the weekly chart, it's not bearish. It's not bullish. This weekly chart's not trending above the 21 EMA. This weekly chart doesn't have positively stacked EMAs. It's not, the 21 EMA is not pointing to the upside anymore. With that kind of weekly trend structure momentum, I want to operate on the daily charts. As soon as that weekly trend structure momentum turns a little bit subpar, I don't want to see daily buy signals anymore. So it's not enough for our daily chart to fit the bill. Based on the criteria in the indicator, that weekly chart also has to get checked out as well. So this is why right now, we're not seeing a lot of daily buy signals anywhere. You look at the weekly chart of the S&P 500, that's not going to cut it. Downtrend under the 21 EMA. When my S&Ps have a weekly chart like this, now I'm interested in taking bullish trades on the daily chart, but not in that kind of trend structure momentum. I want the time frame above me to give me some wind at my back. You can trade your daily squeezes, you can buy your dips left and right on the daily chart when your weekly chart is of that kind of quality. Why aren't we seeing any buy signals in Amazon on the daily chart? Because of the structure of the weekly. We will when the weekly chart looks like this. We won't when the weekly chart looks like that. And we will when the weekly looks like that. So that rule applies to every time frame. I don't want to take an hourly squeeze, right? So right now on Amazon, we got an hourly buy signal. I don't want to get long on the hourly if my 2-hour chart is awful. But the 2-hour chart here checks out just fine. We're above the 21. There's no negatively stacked DMAs. Does this make sense, guys? With a 2-hour chart like that, I don't want to get bullish off the 1-hour chart. But if the 2-hour structure can give me a little bit of support, provide a little bit of wind at my back, okay. Now inside of that 2-hour trend structure momentum, then I can take it down a notch and look for some hourly buy signals. So more on that later, but I think, in terms of what makes our signals here really powerful, it's the fact that we're not going to get caught up getting long on one time frame if all the other time frames around it are trash. This is kind of the nicest way to put it. But that's why right now we're not seeing a lot of daily buy signals. Now, Amazon's daily chart's not perfect, so that's a problem. Let's just pretend Tesla's daily chart's perfect. Has everything we're looking for. We're still not ready for a daily buy signal. Right? When my weekly chart's pumping like this, yeah, give me a daily buy signal every day. But not during that kind of junk. There's no wind at my back. So I hope that makes sense, but there's a few examples. Right? That's why right now, because of the structure of the weekly charts, there's not too many daily buy signals out there. Not too many. All right, so Zoom. Now, Zoom's daily chart's not pretty, but the 30-minute chart is. We'll take it where we can get it. Right? Valero, buy the dip. And then for those of you in the options room, we had some nice trades last year in Google. Google gave us daily buy signals last year because it was in a weekly uptrend. We haven't had a daily buy signal in Google, I don't think all year long, because the weekly trend went to crap. All right. And then all we're trying to do is just follow these labels. Right? So as I continue to mention, we're all in a market where I think we're looking for these trades across all time frames. Right? Daily chart to a 5-minute. We can work that bullish playbook, right? Buy the dip, trade the squeezes on any time frame, as long as that signal is active. With the labels here, now our job of identifying where we can take these trades, heck of a lot easier. Heck of a lot easier. And I love getting emails like this and messages like this. Just keep in mind, you don't need 10 per week. So I also think there's this notion that in a volatile market, we got to be hyperactive and we're shaking and baking and slicing and dicing. No, couple good trades per week, couple nice base hits, sprinkle in that 80% return every now and then. More than enough. More than enough. Then we have our sell signals, right? The big bear. When the red arrows or labels, which coincide with each other, are printed, that time frame and the time frame above it meet our bearish criteria. Right? As long as our sell signal is active, the path of least resistance for that time frame is to the downside. So of course, on the setups with the big 3 sell signal, that's where we're looking to execute the trades from the bearish playbook. And we're going to go into this in more detail, but there's only 2 trades in the bearish playbook. Short bounces to the 21 EMA, get short inside of a squeeze. We're only going to look to do that, guys, if we have our sell signal on that time frame. Regardless of our opinion of the market, regardless if we think the market's going to roll over, we're in no position to get short if we don't have a single sell signal. But the same rules apply as far as multi-time frame analysis. If my weekly trend is bullish, I don't want to get short on a daily chart. That was one of the best ways to lose money in 2020 and 2021, was trying to get short inside of a ridiculously bullish market. Like the easiest way to lose money was trying to do exactly that. We're not going to do any of that. We're not even going to think about doing any of that because our signals won't even show up when we're in that beautiful weekly trend. So again, really, really important. But for us to get a sell signal on any time frame, same rules apply. The time frame above it has got to fit some criteria as well. So, right, for example, I only want to short a daily chart inside of a bearish weekly chart. So remember, like one of the earlier slides, the weekly chart of the QQQ during 2020. I don't want to short those daily charts if the weekly is ripping like that. Too strong, right? Too much momentum, too much bullish structure. Yeah, you can short it every now and then and make out just fine, but that's not the high probability trade. Right? At the end of the day, that's the goal. Point us to nothing but the high probability trades. In a weekly uptrend, jumping down to that daily chart and selling some call credit spreads, it's just not a high probability trade. Right? In a downtrend, same rules apply. So we only want to short when the time frame we're focusing on and the time frame above it are lining up together. So the daily sell signal is looking at the weekly and the daily. Our 4-hour sell signal is looking at our daily and our 4-hour. Our 2-hour sell signal, looking at the 4-hour and the 2-hour. The 1-hour sell signal, 2-hour, 1-hour, etc., etc. So right now, guys, you'll notice there's not too many 4-hour sell signals. So can anybody guess why right now we're not seeing too many 4-hour sell signals? What has to come together for a 4-hour sell signal? Yep, exactly. We'll look at a few. Now you'll notice that the S&Ps, we get a couple of buy signals, right? We're not screamingly bullish here. Oh, this is Tesla, sorry. Hey, we're not screaming bear here. But I don't want a 4-hour sell signal if my daily chart is above the 21 EMA, positive histogram, really trying to improve the structure. Show me that 4-hour squeeze here, right? Show me that 4-hour sell signal during that kind of push. We've got no place getting short on a 4-hour chart soon as our daily chart starts to improve. We'll take them all day during that. We'll take them all day during that. But the daily chart improves some structure. Doesn't mean it's bullish, but it's not bearish enough anymore to warrant us wanting to get short on that 4-hour time frame. Why can't we get a sell signal on the 4-hour chart in Amazon? Not because Amazon's all kinds of crazy bullish. I mean, all we really have is an hourly buy signal, but we're not going to get a 4-hour sell signal because the daily chart has improved. Give me a 4-hour sell signal over here. I love that trade, right? Give me that in here. I love that trade. I don't want to see them anymore when the daily chart no longer looks like that immediate path of least resistance is to the downside. So what the indicator has to do is look at two different time frames, take them through, similar criteria. We only get our signal when everything is kind of going hand in hand. When your daily chart has bearish trend structure momentum, then we can go look to take shorts on the 4-hour chart. As soon as that daily chart improves, we don't have the same support anymore to short on the lower time frame. All right? So that is why we're not seeing too many 4-hour, 2-hour sell signals right now. It's not that things are crazy bullish. If things were crazy bullish, we'd know what we would see. We'd see buy signals everywhere. But the big three, not bearish enough right now up to our standards for the market to be pumping out a bunch of sell signals. It's all a little bit more neutral right now. A little bit more neutral. And we just took a look, so we got that out of the way. All right, so sell signals are looking for squeezes, price action at or under the 21 EMA, negatively stacked EMAs, right? Bearish ADX DMI, but it has to take into consideration both time frames. I don't need the time frame above it to fit all the criteria, but I need it to fit enough that it puts the odds in our favor of the time frame one notch lower, moving in our desired direction. So that's where Eric had to work extra hours to build in all the extra lines of code there. But I think really, really important. So for McDonald's, EMAs stacking negatively, right? ADX under 20, green, red above green DMI. All comes together for a good short. We short it at the 21, we take it down to -2, and we got to take our profits there because now there's a growing probability old Mickey D's has got to head back home. Quick little trip to that 21 EMA. All of that, moving averages, DMI, or just this. I don't got to look at all those things. I don't have to look at 2, 3, 5 different time frames. When I get that daily sell signal, that pretty red arrow on my daily chart, I know my daily fits the bill, and I know my weekly chart is also supportive of continuation to the downside. We're not getting that right now. That's why we're not seeing too many. That's why we're seeing the daily sell signal start to disappear. So pretty straightforward, guys. And then squeezes the same thing. It really is that simple. You find a 30-minute squeeze pumping out sell signal after sell signal after sell signal. You know the 30-minute chart. And keep in mind, guys, if in any of these screenshots, if the labels don't match up with the arrow, just keep in mind, these are screenshots I took last night or this morning. At the time when, back here, when you had the sell signal, at that time, the label was red. As of this morning, Dick's Sporting Goods happens to have a 1-hour, 30-minute buy signal. So hopefully no confusion on that. Just, for the presentation, focus on the arrows. But of course, in real time, they both line up. But you find a squeeze, you find the red arrow. We don't have to go look at the time frame above it. We're not going to get that arrow unless the structure of the hourly chart is supportive of more downside. In other words, as soon as the hourly chart kind of cleans itself up, no more 30-minute sell signal. Pretty straightforward, right? As long as that bad boy keeps printing, everything's coming together for the path of least resistance to still be to the downside. You short, you bounce, you short, you bounce, you short, you bounce. We can really get aggressive as long as that signal is active. Then we got to know when to cut it loose. So 2 playbooks, guys. Okay. Buy signal, we got the bullish playbook trades. We're doing 2 things at the buy signal. And then with our sell signal, we're doing 2 trades. 2 trades out of our bearish playbook. Then when things are neutral, so the daily all the way down to the 5-minute, you got the yellow label. Typically just means no trade, or maybe an iron condor. Right? If you want to bank on a bit of a back and forth choppy market, my major focus is just getting long or short when everything lines up. That's my major focus. All right, guys, so that is the basics of the indicator, right? Following the pretty colors. So essentially what the indicator has to do is it's taking everything from our list, trend, structure, momentum, criteria. You know, there's like 7 different things. It'll start to plot that signal when 6 of the 7 are coming together on both time frames. If the time frame above the time frame we're trying to trade does not fit the bill, we're not going to get our buy signal or our sell signal. So now all we're trying to do is work 2 trades for the bullish setup and then 2 trades for the bearish setup. So I'll move on to part 3, but before we do, jump over here in the chat. Yeah, Subash, exactly, but we don't have to go look at the bigger time frame. The indicator is going to do that for us. The indicator is going to do that for us. So, for example, we only want hourly buy signals if the hourly and the 2-hour chart fit the bill. I don't have to look at the 2-hour, but sure enough, yeah, we're trending above the 21, no negatively stacked EMAs. You know, nothing about that 2-hour chart tells me the path of least resistance is to the downside. So inside of that, we can produce our buy signal. But if my 2-hour chart still says path of least resistance is lower, we're not going to get the hourly buy signal. So we don't have to look at it across multiple time frames. This signal does that for us. So look through a few names here, like Cisco. 30-minute buy signal, so of course, 30-minute chart lines up. Hourly, the hourly's got some structure to it. Hourly chart looks like this, no 30-minute buy signal. Another example, Microsoft. No buy signals. Nothing to do on Microsoft. How about but Procter & Gamble? Daily sell signal. So we wouldn't even look for a bullish trade here. Coca-Cola. Neutral. So nothing to do here. Right, the next round of slides here, guys, talks about the playbook, right? The bullish trades, the bearish trades. We're not doing that on something like Coca-Cola. Neutral, 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 neutral everywhere. There's nothing to do here for a trade. Technically, could you go sell a big iron condor? Sure. But my preference is let's focus on the directional trades. Cisco, in a split second. Okay, let me go check out the 30-minute chart. Lighten up bright green. I know it fits all the criteria. Right? I know it's lining up, getting ready for a move, and it's bright green. Now I know we got my criteria, and we've got the red dot squeeze. We'll do one more here. How about Yeti? So I know my 1-hour chart and my 2-hour chart are good enough here for a potentially bullish trade. The 1-hour has the buy signal, but it only has that buy signal because the 2-hour chart, there's the weekly, because the 2-hour chart has got some structure and trend as well. 2-hour chart looking like that, we're not going to see that hourly buy signal. So keep that in mind. We don't have to look at the next time frame. There's no point. Hourly chart lighten up. You know your 1 hour and your 2 hour chart checks out. What I used to do is, okay, let me check the daily. All right, what about the 4 hour? What about the 2 hour, the 1 hour, the 30-minute, the 15-minute, the 5-minute? It's a lot of work. And one time frame looks good, so you kind of get sucked in, just following the pretty colors. Heading back home with a Happy Meal. Exactly. What do these nesting look like on the big three? Not sure what you mean by that. Tony, how many time frames do I want to see before I would take the trade? Good question, Tony. So the strongest stocks, see if we can find a few examples. Yeah, there's not too many out there right now. But the strongest stocks out there, the ones that can really make the biggest sustainable push, naturally they're going to be the ones that have buy signals across multiple time frames. So as of late, Grocery Outlet, one of the examples of a name that for a while from head to toe had a whole bunch of buy signals. That's pretty strong. If from head to toe, everything's lining up, pretty strong. The dollar, that big push for the whole duration, we had our buy signals. So great question. The more signals, the better in terms of getting real conviction that there could be a big move. But then for me, it's kind of as simple as, hey, if all I have, like on Cisco, if all I have is that 30-minute buy signal, then I can go to that 30-minute chart. And as long as that buy signal's there, I can get to work on that 30-minute. There's no daily buy signal, right? I got no expectation here. This rallies for 8 to 10 days. But as long as things are coming together on the 30-minute, I can operate within that time frame. So that's where from trade to trade, we need a little bit of context. Like Tesla, for example, I got a 1 hour and a 30-minute. Now, those are the time frames I can work with. If all I have is a 5-minute, like I'm trying to think of an example here, maybe Apple. Apple's only got an hourly. That's all I'm going to look for. Trade the hourly chart, catch my move towards +2, and that's about it. So I'm willing to trade whatever time frame has a signal. But yeah, if there's 4 or 5 buy or sell signals at once across multiple time frames, that's where you can get a bigger move. So imagine instead Apple has a daily 4 hour, 2 hour, and a 1 hour buy signal. Well, now we can use the hourly here as a quote unquote early entry to try to catch the push on all those bigger time frames. So sometimes you'll have signals nested inside of other signals. There's a 4 hour buy signal inside of your daily buy signal. There's a 2 hour buy signal inside of your 1 hour buy signal. There's a 30-minute, et cetera, et cetera. Based on the current market, at least on bullish trades, it's a bit more on 1 or 2 time frames versus from head to toe. Where we've seen kind of the full stack of the signals has been on the short side. Daily, 4 hour, 2 hour, sell signals all the way down to the 5-minute. All the way down to the 5-minute. But all right, guys, we'll keep banging out the slides here. Leave ourselves plenty of time today. All right, so part 3 is the playbook. The trades. So for the bullish playbook, right, which I only do on setups that have the buy signal, there's 2 trades. The squeeze and buying the dip to the 21 EMA. And sometimes it's the same trade. It dips to the 21 EMA and then squeezes. But that's it. 2 trades in my toolbox. I don't think you need too much more. So, of course, the number 1 trade is the squeeze. Squeeze is the buildup of energy, leads to that big directional push. Our buy signal tells us the odds favor that squeeze firing to the upside. So, of course, one of our rules is we're not going to get long in a squeeze without a buy signal. Right? It wouldn't make too much sense to do that. We want A plus or nothing, guys. And then, like I mentioned, time frame, it's not really what's most important, right? It's the criteria. So whether it's a 5-minute or 30-minute, when a squeeze has our buy signal, there's a strong probability of a push towards 2 to 3 plus ATR on that time frame. So whenever we're trading these bullish squeezes, we're getting long always at that 21 EMA, and we're taking profits at 2 to 3 plus ATR, regardless of the time. All right. Take 3. We're good to go, Mirza? All right, my man. Sorry about that, guys. Yeah, they're doing something down the road, and I think we should be golden for now. But for your troubles, here's what I'm gonna do. Let's go back to slide number 1. And for your troubles, guys, we'll do 6 weeks. We'll do the Thursday meetup for 6 weeks instead of 4. Just for the technical difficulties. How's that sound? But all right, now we're going to talk about the playbook trades. It's like, my God, Taylor, just tell us the trades. Just tell us the trades. All right, awesome. Yeah, I appreciate the patience, guys. I think Amelia, it was the last class we did where I got hammered with the blizzard. It's like, of course, Massachusetts gets the worst blizzard in years on the day of class. But all right, guys, part 3, the playbooks. Bullish and bearish playbooks, we only got 2 trades. And of course, we're only doing these trades on the setups that have our buy or our sell signal. So for the bullish playbook, trade 1, my favorite, the squeeze. And then the second trade is just simply buying the dip to the 21 EMA. And we know the squeeze is the buildup of energy. Right? It's getting ready for that 20% of the time where the magic happens. Focusing on the signals, that stacks the odds in our favor of that squeeze firing to the upside. So of course, one of our golden rules is we're not going to get long in the squeeze without a buy signal. Just wouldn't make too much sense to do that. We only want top shelf, right? A plus or nothing. And then remember, it's not the time frame that matters. And that was, I think, one of the mistakes in my mindset coming up as a trader. Yeah, I trade weekly charts and I trade daily charts. Trade the time frame that fits your criteria, right? That moment in time doesn't really have anything to do with the weekly chart. Doesn't really have anything to do with the daily chart. It's about everything coming together at once, setting up for a good trade on that time frame. And then as always, guys, in these squeezes, we're getting long at the launching pad, 21 EMA, and we're taking our profits on that push to +2 to +3. But we're in a market where if it's on the 5-minute chart, we can take them on the 5. We can take them on the 5. We can take them on the 5. NVIDIA 5-minute squeeze, buy signal. AMD 5-minute squeeze, buy signal. So the key is we want to get aggressive when everything is lining up. So just these few squeezes here, these were from the scan, which are going to run here in a little bit, from last Tuesday. So about 30, 45 minutes before the close, fired up the big 3 squeeze scan, did the 5-minute, the 15-minute, did every time frame. Bunch of beauties on the 5, right? The Qs, the S&Ps, Amazon, NVIDIA, AMD. But then you run the scan, you find something on the 30-minute chart like Zoom. There's that moment in time. We're building up energy, right? Zoom is pounding back on some Gatorade, getting ready for its next push. Our pretty green arrows tell us the odds really favor that squeeze fires to the upside. What's also, I think, really cool, out of curiosity, how many of you trade the futures? We got any futures traders in here? Great question, Dale. Dale, what I've been seeing a lot of as of late as far as, hey, there's a lot of opportunity here. 5-minute, 15-minute, 30-minute, 1 hour. We'll get a couple to 2 hours right now. We'll every now and then see a 4-hour, but it really is an hourly chart and down. Okay, a lot of futures traders, awesome. What I've been enjoying doing, And I'm really thinking about maybe I want to start trading some futures here. Not too sure how thrilled my fiance would be about it. I probably wouldn't leave the office too much. But even on something like the Bitcoin futures, and we took that trade last week in Coinbase. Part of the reason I took a trade in a quote unquote Bitcoin related stock was I'm sitting here watching the Bitcoin futures hourly squeeze with a buy signal. Pull back, right? Reversion to the mean, hourly squeeze with a buy signal. So watching these on the futures, I think is really helpful. Granted, I don't trade the futures as of right now, but part of the exercise we're going to do is every single morning, go do your big three check, right? Look at all your labels on the ES, the NQ, the YM, right? The IWM futures, even on Bitcoin. That gives you a great sense of how are things setting up overnight in pre-market, and it gives you a sense of potentially what the tone might be for the day. So if we come into the session, like we did a handful of times last week, overnight, the NQ, the ES, they start popping out picture perfect 30-minute squeezes with buy signals. Gives me a pretty good sense that, you know what, that might fire long and that might set the tone for today. But yeah, Bitcoin was pumping there last week. And, we're going to get back to a market. I don't know when. None of us know when. But at some point during our trading careers, yeah, we're going to get back to a market where I think we can just transition, if we want to, back to focusing on nothing but the daily charts. Really, though, this year, all we've had was energy for a little bit, natural gas, a little bit of crude oil, agriculture. That's been about it, though. And now those 3 or 4 spots, they don't even have the daily buy signal anymore. But the point I'm trying to make, guys, and hopefully the more I pound the table on this, the more it sinks in, time frame doesn't matter. Yeah, our trade taken off of the daily chart, we're going to have to give that a bit more time to expiration. It might be a little bit slower to unfold than a trade on a 5-minute chart. But each of those is a plate of opportunity if things line up to produce our buy signal. So to me, that's kind of liberating. I don't remember the last time. It was probably UNG a couple of months ago where I took a trade off of a daily chart. A year ago, I kind of had this feeling, what am I going to do if we go into a market where this all stops? Like, what am I going to do if it's no longer as easy as run my daily squeeze scan, sell some put credit spreads, and then come back a week later and take profits? There was a part of me thinking, like, I'm going to have to change. Like I got to go back to the drawing board. I got to rewrite my own book. I got to make new rules. I got to focus on new criteria. The biggest realization was that trade there on Oxy, yeah, it'll unfold a little bit slower. Yeah, we got to give it more time. It's the same thing as that hourly squeeze in the Bitcoin futures. It's the same exact thing as that 30-minute squeeze in Zoom. And it's no different than the 5-minute squeeze in AMD. There's adjustments to be made, and we'll talk about those adjustments, but hopefully that makes sense. And maybe there's a lot of you here today who have traded a bunch of time frames. Maybe you're used to this. I do think for a lot of us, though, coming up as traders, we kind of fall in love with a couple of time frames, and we tend to just stick with those time frames. Reality is, as we transition from bull trends to bear trends to choppy markets, as we make these transitions, certain time frames are going to be preferable. If you can just focus on the same criteria, right? Take whatever your go-to trade is on a weekly chart. I promise you can find that all over the place. So long as you're willing to pop the hood and look on the 5-minute, a 15, look anywhere. And we're going about finding these trades, not by having to go through hundreds of charts, right? We're never going on Twitter for the latest, hot stock suggestion. We're not going on Reddit. I think in the long run, guys, this squeeze, the scan here, for me at least, I think in the long run, it's going to be worth millions of dollars. Because now in like 30 minutes tops, probably not even 30 minutes, I can go through a 5-minute, a 15, a 30, a 1 hour, a 2 hour, a 4 hour, a daily, and get nothing but my go-to setup. I think the scan is amazing. So that's all we're doing to find these opportunities. And that's what we're going to do here in a little bit. Fire up the bullish and the bearish scan and start to build our watch list. But I think a good scan, like a focus scan, really going to be your best friend as a trader. So we got the squeeze. I don't think it gets much more straightforward than that. Find it on whatever time frame we can find it. If we got that pretty little green arrow, we know that squeeze has a pretty good chance of making that move in our desired direction. My other bullish trade, buying the dip. So show of hands, guys, who was enjoying the heck out of buying the dip back in 2020, 2021? Good times, right? Good times. Yep. So that was kind of the name of the game. Buy dips in the weekly charts, buy dips in the daily charts, right? We'll wake up. We ran our scans. Wasn't too tough to find an uptrend because everything's in an uptrend. You buy a dip, you get long, you hit the beach. The market was so strong, there's so much money flooding in. Yeah, maybe you take a little bit of heat in the short term, but that crazy bull trend just kept on bailing you out, bailing you out, bailing you out. Different market right now, but yeah, when we get a market like 2020, 2021, it's a total blast. So all you have is names like Apple. Pull back to the 21, buy it. Buy the dip, buy the dip, buy the dip, buy the dip. Tesla. Buy the dip, buy the dip, buy the dip. Buy yourself a dip, buy yourself a dip. Over and over and over again. That's last year. Right? What about this year? Even though we're in a downtrend, and like I mentioned, there's just not too much right now on these bigger time frames. But at a few points this year, there's still been a few spots where buying the dip on those bigger time frames worked great. And of course, it works great on those things that have the buy signal. So we're only going to look to buy the dip when that trend, that structure, that momentum tells us the path of least resistance is still to the upside. Right? In other words, only buying the dips on setups that have our buy signals. Now, is it in the daily charts right now? Oh, we had a few. Right? They were great while they lasted. We traded a lot of the energy stocks. Right? We traded a lot of natural gas. Yeah, that might be the easiest trading strategy out there. Find a daily chart with the buy signal. Just take every dip to the 21 EMA you can get. Valero was nice. Natural gas was a animal. Right? Total nut job here. But that little green arrow tells you, yep, that's your dip to buy. Right? That's your dip to buy. Oxy, squeeze, buy signal, huge push. Pull back to the 21, buy signal, buy the dip. Pull back, squeeze, right? Over and over and over again while things are active. Anyone could do that. I really believe when a market is pumping like that and things just continue to trend higher, anyone can go in there and buy the dip, right? We're trying to get the A+ trades and nothing else. Setup can only be A+ if we have our signals. So to me, it's not even so much a question of, hey, when can we buy the dip? Where can we buy the dip? That's easy. You buy the dip with the buy signal and you do it to the daily 21 EMA. The key is how can we keep all the money that we make buying the dip? And how do we know when it's time to stop buying the dip? It's an easy decision for us. We immediately stop buying the dip when our buy signal disappears. No matter how much money we made, no matter how strong it looks or feels or smells, no matter how good buying the dip has been working, we don't buy the dip without our buy signal. Simple as that. So UNG, who just feeds you day after day, week after week, month after month, right? You feel like a pro. Buy the dip, buy the dip, buy the dip. All of a sudden, what happens? Like, how can something that was just so strong, such good trends, such good momentum, such good structure, look how quickly it craps the bed? Our goal, guys, is on that first day right there where we lose that buy signal, we're done. Like, we're done. No questions asked, no emotions, right? No favorites. Buying the dip, getting long worked really well for us because trend structure momentum was fully aligned. As soon as that signal disappears, it doesn't mean things are going to fall apart. It doesn't mean things are a short. We only short things with our sell signal. All we have to know, something has changed, right? Something in our ingredients, something about that big three combo, it's not up to our standards anymore. That's when we're done buying the dip, and we don't do it again until our buy signals pop up again. Easy enough to make money when it's all in motion. All it takes is you buy that dip a few more times, and UNG keeps on dipping. It's so easy to get back all the profits you made from the trades that worked when things were A+. Got to cut it off, guys. No buy signal, no trade. We're not getting long in the squeeze. We're not buying the dip. We're not doing a damn thing when we lose that buy signal. Right? You seen Valero today. Beast. Great move, great move, great move, great move. What happened? Buy signal disappears. It's not good enough anymore. It might gap up the next day. And all right, if it does and there's a buy signal again, guess what we can do? We can get long. But something has changed. That's when we're done getting long. We move on to a greener pasture. Because if we don't, we buy that dip 1 or 2 more times. Easy enough to give back all those profits. I don't even want to give back one profitable trade. I still think that's one too many. No buy signal, no buying the dip. Right? Tesla, beast, buy the dip, huge rip, buy the dip, huge rip, buy the dip, huge rip. Notice how the buy signal starts getting a little bit flaky. It's on, it's off, it's off, it's off, it's on, it's off, it's off, it's off, it's off, it's off, it's off. We should be nowhere near Tesla before this ever makes that big breakdown. I'm okay with, we got a buy signal on Tuesday, we get long, and then it's gone on Wednesday. We got to jump out. I'm okay with that. But what I'm not okay with, and what none of us should be okay with, is we ignore the fact it's no longer up to our standards, and we keep forcing the issue. Opinions get involved. We're picking favorites. We have biases. No pretty color, no trade. So criteria, I think, is way more important than the time frame. Right? And we're not in the market right now. We will be one day. Right now, though, we're not in a market where those picture-perfect bullish trends are on the weekly charts and the daily charts. So one might think this means, well, we're not in the market where we can buy the dip. I disagree. Right? Just like trading that bullish squeeze, we'll take a bullish squeeze on a daily chart down to a 5-minute. We can buy the dip to the 21 EMA on any time frame that has our buy signal. As long as the buy signal is there, you can take that playbook trade that worked so well last year and the year before on weekly charts and daily charts and 3-day charts. We can go do the same exact trade on an hourly chart. I want you guys to just ignore the fact this is a 1-hour chart. Understand it's the same principles. Pretend this is an hourly chart as well. Your trend, your structure, your momentum, it's coming together enough to justify our buy signal. You can buy those dips left and right. If you're reliant on only doing that on a weekly or a daily chart, there's dips for you to buy in this market, but they keep on dipping. But that dip to the hourly 21 here in Zoom, it's the same trade, guys. I'm not going to hold it as long as I'll buy the dip on a daily chart. I'm not going to expect it to rally for 8 weeks like I would if I'm buying a dip into a weekly chart. But the art of buying the pullback really comes down to, what are you buying into? Are you buying into bullish trend, structure, momentum? As long as you are, you can buy that dip and continue to buy it, so long as that time frame has the buy signal. So up until this year and up until recently, I don't think I've ever bought a dip to an hourly chart. Like that wasn't even in my vocabulary. Buying a dip to an hourly chart, like who does that? Tell you what, it's a great strategy if we got the buy signals. So in the options room, this is a trade that we did a few weeks ago. Got the dip, sold our put credit spread. Buy signal told me, as long as I keep popping out, path of least resistance is to the upside. If you buy a dip on a monthly chart, You need to buy a dip into trend structure momentum that suggests path of least resistance is to the upside. If your 5-minute chart has trend structure momentum that suggests the path of least resistance is to the upside, you can buy that dip on the 5-minute. We'll play ball, guys, wherever we can get it. Costco, buy signal, buy signal, buy signal. Remember our rules. We don't want to chase these things up here at +2. So what I've been doing a lot of lately is, okay, I missed the initial push here. That's okay. I don't got to catch them all. But I'm going to sit back now and wait for that dip. Costco pulls back, keeps popping out that hourly buy signal. Signal keeps printing. I can look for my entry at that hourly 21 EMA. Even better, pull back to the 21 EMA and then go into a squeeze. Beautiful trades in this market. One of my favorite setups into next week, guys, is Tesla. As a lot of us know, well, all of us probably know, Tesla went a little bit nutty last week. 30-minute squeeze, buy signal. Admittedly, it was right before earnings. That's a total wild card. So food for thought. Don't take these signals the night of earnings. Wait till the next morning. But nonetheless, 30-minute squeeze, buy signal. Crazy rip the next day. We were looking at this in the options room. My advice was, all right, guys, yeah, Tesla looks strong. And Tesla is strong. Hourly 30-minute, 15-minute, 5-minute buy signal, yeah, that's pretty strong. But we got to think of our rule book. We're trying to catch that explosive push, not jump into it. Tesla pulls back to the hourly 21, continues to pump out the buy signal. What I'll be looking for next week here is an entry off that 30-minute 21 for continuation towards 850. Now, if we open up on Monday and the buy signal is gone, then there's no part of me that's going to look for that trade. But hopefully this all makes sense, guys. That looks very similar to the UNG daily chart and the Valero daily chart. Big explosive push. It's a little bit too cooked. Got to come on back home. Right? Remember, they always come back home. Always, always, like a good dog. Here's our next entry. As long as our buy signal is active, that's our spot to get busy. So that is one of the trades I'm looking at for this coming week. And we'll look at a few more trade ideas here in a few. So like I mentioned, the biggest change from time frame to time frame, right? The entry doesn't really change. I don't think it should. The exit doesn't really change. What changes is the speed at which the trade unfolds. You get what I mean, guys? Typically it's not going to take a 5-minute squeeze a month and a half to fire. 5-minute squeeze might fire in 5, 10, 15 minutes. It might take an hour. It might take a day. But that's the major difference. You know, the moment in time on a daily chart is going to move a little bit different, a little bit slower than the moment in time on a 30-minute or a 15-minute. But as long as that signal is active, we can work those two trades, get long in a squeeze or buy the dip on any time frame. Got to make a few adjustments, though. So in terms of strike selection and expiration date, here's my suggestion, guys. I think when it comes to things like this, there's no perfect answer. I think there's guidelines you can follow, but what I really suggest you do is, as you're taking trades of the big three, try to document as much as you can. Like that's what I've been trying to do as of late. Okay, I took a 1-hour squeeze and I gave it 20 days till expiration. Well, how did that work out? Right? I took a 5-minute squeeze and gave it 2 days till expiration. How did that work out? Take notes on these kinds of things. Right? Make important observations. 50 to 100 trades from now, you'll probably have some rules that are written in stone as far as your strike selection and your expiration dates. So these are not hard rules. These are just guidelines. Find what works best for you. But as far as my suggestion, daily setups, I'm a big fan of giving my trades about 30 days till expiration. If we're cranking it down to a 4-hour, I'm comfortable with about 10 to 15 days. Now you guys will notice on a 2-hour, a 1-hour, a 30-minute, I tend to give those trades the same amount of time. 5 to 10 days is kind of the sweet spot. The reason being is we're always trying to strike that balance. Right? We're trying to strike a balance between, okay, we can buy some options here or sell some options here. And if we catch the move, we'll get a good bang for our buck. But we also don't want to be fighting the clock. We don't want to be in a position where we took that 15-minute squeeze, we bought calls that expire the next day, and the next day it doesn't fire and we're in some trouble. We want to strike a happy balance. We don't want to give our trades so much time till expiration that on the move we catch, we're not getting paid too much. But I think the worst thing to do is you take a clean setup, you don't give it quite enough time. The setup just continues to sit there looking pretty, right? No problems, buy signals, looks picture perfect, but then your calls go to zero because you gave them 2 days to work. So again, these aren't necessarily hard-pressed rules. They're a bit more like a guideline. But for the lower time frames, I'm comfortable with about 5 to 10 days. Do I think the 15-minute squeeze needs 5 to 10 days to fire? Absolutely not. But I'd rather my calls not go down 50, 60% if we just trade sideways for 2 days. So that's a balance we're looking for. I want to give the trade enough time to work, but at the same time, if I catch my move, I want to get a good bang for my buck. If we buy calls in a 5-minute squeeze and those calls expire in 90 days, we're probably not going to catch a big bump in those calls on a trade based on a 5-minute chart. So try to strike a balance, guys, but like all things in trading, take notes on all this stuff in your own observations. You might find that, I like that 5-minute squeeze, and I like doing options that expire that day, on the S&Ps or something like that. You might find that you're comfortable giving a trade more time than needed, and yeah, your percentage return might not be as explosive, but you have less headaches. You're not as concerned about premium decay eating away at your options. So these are suggestions of what to begin with. But yeah, I do suggest over time, guys, take notes on these things. You'll figure out for your style of trading, your temperament, your emotions, what the good balance is. Our Cisco trade from last week, the trade only lasted 2 days. We didn't really catch an explosive move. We bought calls that expired, I think, like 2 or 3 weeks from now. We, quote unquote, only got like a 15% return. Now, had I bought calls that expired in 2 or 3 days, the percentage return would have been bigger. So I think that's what's attractive about trading options that expire really soon. If you buy them, you can catch an explosive move. And if you're selling them, you can collect your premium quickly. But before we took profits on Cisco, we also had to sit through a pretty decent dip. We had to sit through a little bit of chop. Because our calls had some decent time left, we weren't getting hammered on that little bit of choppiness. Get where I'm coming from? Trying to strike that balance. Yeah, if I bought calls that expired Friday on my Cisco trade, it would have been a bigger percentage return. However, during that choppiness, it would have been a little bit more painful. We might have been down 50, 60%. So food for thought, guys, but for daily charts, 30 plus days, that's my sweet spot. For 4-hour, about 10 to 15 days. And then for the 2-hour, 1-hour, 30-minute, and even the 15-minute, 5 to 10, that's where I'm pretty comfortable. 5-minute time frame, I lean a little bit more towards 5 days, but I do think 2 to 5, it's a pretty fair window. And then as far as strike selection, simple stuff, guys. Different markets, I think, call for different usages of option strategies. So when it comes to selling put credit spreads, in a 2020 market where we're trending, we dip a little bit, we keep trending, we keep trending. I like to sell out the money, put credit spreads, give them all the time in the world, and just kind of sit on it. Let that premium pour in. In this market, when it comes to put credit spreads, I'm just selling the at-the-money strikes. 5-minute chart, daily chart, I sell the at-the-money strikes. And if I'm buying calls, so we got a bullish squeeze, we're buying the dip to the 21, at the money, in the money, take your pick. My preference is Delta 70. That's usually 1 or 2 strikes in the money. Delta 70 with the right expiration date gives you that balance that we're looking after. Delta 70, you're not as worried about premium decay. You buy a deep out the money call, you better catch that move and you better catch it immediately. Delta 70 is far enough in the money where we're not too worried about premium decay immediately, but at the same time, it's not so far in the money that it's crazy expensive and we're not getting a good bang for our buck. So that's kind of what I was taught years ago. You buy a call, you buy a put, you typically go with the Delta 70. That's what I have found is a sweet spot, guys. Buy calls, Delta 70, put credit spreads, sell on the at the money strikes. So recap of the bullish playbook, right? 2 trades, the squeeze and buying the dip to the 21 EMA. We only work these trades when our buy signals are active. So as long as we got that buy signal, that pretty green label, that pretty green arrow, we can take these trades on any time frame. Daily down to the 5-minute. Always aim to take our entries at the 21 EMA. Always aim to take our profits on that push into +2 to +3. And we always, always, always stop getting long. We don't buy the squeeze. We don't buy the dip when our buy signal vanishes. Buy signal vanishes, we've got to vanish as well. So 2 trades in the bullish playbook, 2 trades here, guys, in the bearish playbook. Right? So for the setups of our sell signals, we're looking for bearish squeezes, and we're looking to short the rally to the 21 EMA. Okay? Just a total opposite. So for the bearish squeeze, sell signal tells us the odds are really in the favor of that squeeze firing to the downside. So of course, a golden rule, I will not get short in a squeeze without a sell signal. Can't do that. Can't be doing that. And we'll take them anywhere. 10, 15, 30-minute, 2-hour. We'll take them wherever we can get them, guys. And the same entry and the same exit rules apply. In a bearish squeeze, we want to get short at the 21 EMA, and we're looking to take our profits on that flush into -2 to -3. So IWM, 15-minute squeeze, 15-minute sell signal. That makes for a great flush towards -2 on the 15-minute chart. Dick's Sporting Goods, 30-minute squeeze, 30-minute sell signal, right? Time and time again. That makes for a great flush to -2 ATR on the 30-minute chart. Daily squeeze, daily sell signal, short at the 21. That makes for a good trade for a flush down to -2 on that time frame. So again, that trade right there is the same exact trade as that trade right there. And that trade right there is the same exact trade as this one right there. You give the 15-minute squeeze maybe a little bit less time to expiration, but it's the same entry, same exit. You give the 30-minute squeeze maybe a little bit more time to the expiration. It's all the same though. Same ebbs and flows, same execution, same entry, same exit. BAB, right? Never even heard of this stock, but daily squeeze, daily sell signal, pretty good chance as long as that signal's active, that's heading down towards -2. And that's where we take the profits because we're trying to avoid being the short squeeze. And finding the bearish squeezes, guys, is just as easy. Then we got the bearish big 3 scan. So we're going to fire up both of those here in a minute, but the scan does the job for us. We can look on the 5, the 15, the 30, 1 hour, all the way up to the daily chart. So we got the bearish squeeze, short in the squeezes, then we got short in the rally, right? The opposite of buying the dip. So in an uptrend, a bullish market, a lot of times buying the dip is going to be the key to success. In a downtrend, we're looking to short the rallies. I think for a lot of us in a downtrend, that becomes one of the go-to trades. We know path of least resistance is lower if we got our sell signal. So if we can find those sell signals, those rallies to the 21 EMA on any time frame, those make for some great short the rally opportunities. I think shorting a downtrend is just as easy as buying the dip in an uptrend, especially on these bigger time frames. So like Zoom, for example, you can wipe the floor clean with this thing for the last, from January to May. You're taking candy from a baby. Get short, take profits on the flush. Short the rip, profits on the flush. Right? Short the rip, short the rip, short the rip, short the rip. As long as that signal is active, you can really get busy short on those rallies. S&Ps, even on a 30-minute chart, we gap down. We don't want to get short under -2 ATR, so we wait for that to come home, because they always come home. Notice here, guys, how as the S&Ps are rallying, we start to get our sell signal. The market's rallying off the bottom, but then we get our clue that we might want to look to short at the 30-minute 21 and catch a flush towards -2. Makes it all pretty straightforward. DoorDash, we had 2 or 3 shorts in this one. Easy stuff. Easy stuff. Snapchat, I think we had 1 or 2 trades on this in the options room. When everything comes together, it's just not that difficult. What's difficult is being able to go from shorting something like Zoom almost every week for 5 months straight, and then on one day saying, I'm done getting short. So just like when we're buying the dips, guys, we need to stop shorting the rally when we lose our sell signal. And I think this is even more important than stopping buying the dip when we lose our buy signal. And we have to stop buying the dip when we lose our buy signal, but this is even more important, right? In a downtrend, the market's going to try to trap you. We get a huge flush, it's trying to spook you, it's trying to scare you into getting puts and getting short. Then you get the short squeeze. The beautiful thing about the sell signals is they help us avoid becoming a part of the short squeeze. We don't have a sell signal, we're not getting short anywhere. Doesn't matter where we're bouncing, doesn't matter what we think. Could only short that rip with our red arrow. So you just saw that chart of Zoom from January to May. Short the rally, short the rally, short the rally, short the rally, short the rally. That's the day we have to stop. Like, no questions asked. We lost our buy signal. We're done getting short. Doesn't mean Zoom's going to trade higher. Right? It's not a buy signal, but it tells us pretty clearly this is not your short anymore. You keep shorting it, keep shorting it, keep shorting it. There goes your last 2 to 3 to 5 months worth of progress. Doesn't always mean they're going to rally, and it doesn't mean they can't continue to trade lower. But in terms of the trades that we're looking for, we know immediately, all right, we're done working that playbook trade on Zoom until it has a sell signal. And better yet, guys, a few weeks later, we're taking that 30-minute squeeze bullish and taking that for a nice little ride. So we can't be faithful to these stocks, right? It's okay to be unloyal to the stocks that you trade. When they treat you good to the downside, when they're looking pretty and bearish, we'll have a grand old time shorting them. But then you got to be heartless, right? You have a nice 5-month relationship with Zoom, shorting every bounce, and then in one morning you got to say, hey, Zoom, we're breaking up. It's been fun, right? We had good times. We made some good memories. I'll look back on the last 4 months with fondness, but we got to stop here. And it's not me, Zoom, it's you. No sell signal, we're done getting short. Right? DoorDash was a great short for a while. That's the day we stop. Doesn't mean it rallies. Doesn't mean it doesn't gap down the next day. What that means is path of least resistance, no longer to the downside. We got to move on. So if you guys look at a few things from last week, the semiconductors have been a dud for months. Sell signals here, sell signals there. That all changed last week. Doesn't mean we get long the semiconductors, but that's how simple it should be. That's the day. There's not a part of us thinking about getting short the semis anymore. We lost our daily sell signal. The S&Ps have been a great short. Push to the daily 21. Sell signal, you catch a flush. Push to the daily 21. sell signal, we catch a flush. That signal disappeared on Wednesday. I can't get short the S&Ps again until we get another sell signal. This doesn't mean we're going to go back to all-time highs. Doesn't mean we're going to make it up there to 405, 410. It just means the path of least resistance isn't to the downside. And it doesn't make too much sense to get short if that's not the case. And then the QQQ. Like I mentioned, you can lose a sell signal and still trade a little bit lower. But notice how it gets a bit more choppy than anything. Yeah, if you're quick, you can catch that flush. But then it bounces, it flushes, it bounces. We're not trending lower anymore. We're just trading back and forth in a nasty box. No sell signal means path of least resistance is not to the downside. I don't want to go buy puts on the Qs right here and hold them for 30 days. I don't want to get caught up in that kind of stuff. I can short that rally with a sell signal and have some pretty good confidence we're going to roll back over. But we got to knock off that kind of thinking soon as that sell signal disappears. So as long as we got that pretty red arrow or our red label, sell signal's active, we can look to work those two trades, getting short inside the squeezes or short in those rallies at the 21 EMA, and we can do it on any time frame. Of course, the biggest difference is your 5-minute chart is going to move a heck of a lot quicker than your daily chart. Same expiration date guidelines, guys. Same things for the shorts. And what a lot of us notice, or will notice, the bearish trades tend to unfold a little bit quicker. Like a little bit quicker. There's more emotion, there's more volatility, and that's really the thing to it. There's more volatility. Volatility rises, you're getting moves in a half hour that you might otherwise get over the course of a few days. So yes, things move a little bit faster, of course, to the downside, but the same rules apply. 30 plus days in my daily charts, even if I think I'm going to take my profits maybe 4 days later, I'm going to give it the full 30. 10 to 15 for the 4 hour, 5 to 10 for the 2 hour, 5 to 10 for the 1 hour, the 30 minute, the 15. Then for that 5 minute, 2 to 5 plus. And I lean a little bit more towards 5 plus. Lean into more time needed. I think that's key. And then strike selection, guys, same rules. If I'm going to buy a put, I'm going to go with Delta 70. Usually going to go with Delta 70. I could go deep out the money, cheap Delta 20. And if I catch a flush, those puts can go up hundreds of %. But if the market trades sideways for a few hours, those puts can also lose like half their value. So to strike that balance, I think Delta 70 is a nice sweet spot. And then if I'm selling call credit spreads, I'm going with the at the money strikes. This is one of the bigger changes with me with credit spreads now. I don't want to sell that call credit spread, 5% above the current price because I'm only trading A plus setups. My expectation with every trade I take now is that this trade's going to work, and it's going to work quickly. I don't want to go sell deep out the money call credit spreads and get like a 5-to-1 risk reward ratio. I've got confidence in these trades. I got confidence this thing's going to roll over. If I'm going to sell a call credit spread, I'm going to go with the at the money. Get more credit, get more premium. We get a better risk reward. The other side of it is, though, I don't need to give my call credit spread all that wiggle room because I don't plan on holding on if this thing doesn't do the job that I hired it to do. I love credit spreads, but that was one of the mistakes I think I made years ago. All right, here's my trade in Apple. I think Apple's going to trade higher. Let me sell put credit spreads so freaking far under the current price that all Apple has to do is not get decimated, and I'll walk away with a paycheck. Very high probability in nature. But if we're trading A plus setups, we want to get our return. Right? We want them to be worth it. So buying puts, guys, go with Delta 70 is my suggestion. That gives you some nice balance. Right? You'll get a nice paycheck, but you're not going to see your puts go to zero in 20 minutes either. And then on the call credit spreads, I really suggest go at the money. Right? These setups are so clean, they either work quickly or they don't. You can go sell deep out the money calls. You can give yourself all kinds of wiggle room. I really don't think we need it. Really don't think we need it. So recap the bearish playbook. 2 trades. Getting short in the squeeze and short in rallies to the 21 EMA. Only work these trades when our sell signals are active, because if it's active, path of least resistance is to the downside. We'll take them on a daily. We'll take them on a 4-hour. We'll take them all the way down to the 5-minute. And the execution does not change from time frame to time frame. Get short at the 21 EMA. Take the profits on that flush into -2, -3. And then the most important rule, guys, stop getting short when the sell signal vanishes. Otherwise, you are going to be the short squeeze. It's not the party we want to be in. It's not a very pleasant party. It gets a little bit rough during that short squeeze party. All right, guys, those are all the slides I want to go through as far as like the nitty gritty, right? The ingredients, the basics of the indicator, the playbook trades. Now for the good stuff, the really good stuff, the daily routine and the scans. A couple different things you want to do every day. You can do it in the morning. You can do it at night. If you're like me, you'll do it multiple times per day. Step 1, check the indices with our big 3 labels, S&Ps, QQQ, IWM. Step 2, we want to check all the major sector ETFs with our big 3 labels. Step 3, check the market leaders, right, the FANG stocks, the big banks, the semiconductors, with our big 3 labels. And then the most fun part of the whole entire process, step 4, firing up the big 3 scans. So that's what we're going to do next, guys. We're going to go through that routine. So for this part of the show, I want you all to go to the class folder and go grab the big 3 market view spreadsheet. All right, really important exercise. We're going to look at the indices. We're going to look at the futures on the indices. We're going to look at a few of these leading sectors, and we're going to grade them out based on the big 3 signals. So that's what's up next, guys. Then we'll jump into the scans, and then we got all the time in the world here for some Q&A. So we'll do one more quick 5-minute break here, but make sure you got that spreadsheet. All right. So we'll do a quick 5-minute break. Quick 5-minute break. Back at 2:55 p.m. Central. All right, my friends, stretch your legs, heat up the coffee, refill the water bottle, and we'll get back to the fun stuff here in a minute. All right, so this is where it all gets juicy. Be right back.